So welcome to the Q3 Lemonade preview. I'm actually on vacation right now with my family, so a bit of a different setup for me here. And also broke my wrist a few weeks ago. I'm very thankful everything is healing well with that injury, but I'm basically just using my left hand, non-dominant hand for everything. So bear with me if I'm a little bit slow moving the mouse around or even coordinating things here. First of all, we just want to walk through in this video where the numbers might kind of come in for Q3 and even Q4 of this year as we kind of look out for this quarter and the end of this year. And hope in this video you get some idea of understanding at least what are the main metrics that I'm looking for and I'm going to be watching, and how we can kind of see the underlying unit economics of the company, how they've been improving and will they continue to improve or not. First thing we want to look at is how many customers might they acquire in Q3. Right now I have here on from my Lemonade model a graph of customer acquisition costs. And you see how it's kind of varied from about $100 a customer all the way up to $191 a customer. Last quarter was higher than normal, $171 per customer. They plan to spend quite a bit of money on customer growth in Q3. If we go back to, here's a nice summary. In the earnings call of last quarter, they said they expect to invest approximately $25 million more in growth spend in Q3 compared to Q3 of the prior year. So that's a big clue. We know they're going to spend $25 million this quarter than they did a year prior. If we flip then over to the model, my Lemonade model here, we have for Q3, if they're spending $25 million more than the previous year, which was $12.6 million, they're at about $37 million spending on growth spend. So a major quarter for growth spend in Q3. Now you kind of wonder, what is their customer acquisition going to be? But we flip over to another tab. I have customer acquisition cost versus growth spend up to last quarter. So it gives a trend line. As you can see, if you spend more on growth, then you end up paying on average more dollars per customer. Makes sense, because at the lowest end you have kind of the easiest customers to obtain. There's a certain number of customers that even if you did no marketing would join anyways. So they're kind of free customers and everybody else you're paying for. And then as you spend more, as you want to get more and more people, the low-hanging fruit, disappears and it gets more expensive, right? So I plotted that out, and you see this sort of trend line here. It gives an equation for that line of where you could kind of predict your customer acquisition cost for growth spend would come in. But interesting thing is Q3, which we're talking about here, Q3 is often one of the best quarters, most efficient quarters for marketing. I think there's just more people moving, more students moving, more transition where you're signing up for renter's insurance. It's a time of year where there's people looking for those products for Lemonades, especially probably their renter's insurance product, maybe car insurance too if you're buying, or car or moving, or etc., that kind of thing. So Q3, I have 3 of these quarters highlighted all in pink, and you can see Q3 tends to be more efficient. Now over on the side here, I just put in these different data points for how much the growth spend they spent, and if you follow the trend line where that value would have come in, would have come in at somewhere between $104 to $164 of customer acquisition costs, but then what actually came in for Q3. And you see from the trend line, there's about a 70 to 76, 77% less than what the trend line average would show. So for Q3 of this quarter, I'm thinking, $37 million they're going to spend. Your trend line would say, hey, your CAC cost is going to be $200, but average customer acquisition cost, I use the larger value, 76% here, and that gives you $155 of actual CAC. If you use one of the lesser numbers like 71%, which even this is kind of scaling, as they're actually scaling faster, like the slope is, if you follow the slope through these 3 lines, it's showing greater improvement off the trend line as you expand the amount of marketing spend. So I don't know, I went with the more conservative number, 76. You could go 71. This would have improved this customer acquisition cost even further. I also think, in Q2 they ramped up some larger kind of billboard campaigns, broad sort of more traditional advertising campaigns in a number of cities across the U.S. And the expenditure of that was lumped into Q2, which is partly why we saw a higher CAC cost Q2. But in Q3, we should start to see the fruit of some of those values. So I wouldn't be surprised even if the actual value came in better than this 155. But that's where I'm putting in my values right now, at least. Now I flip back to the model. If we put in $155 for Q3, and if we assume 16.5% churn, which is roughly where we've been at the last couple quarters from customers 12 months prior, you go back to the customer count, how that changes and grows. We're at about 160,000 gain of customers in this quarter to about, a little bit over 2.3 some million customers. If we look at a graph of net customer growth, how much that's changed, you can see relative Q3 is still be one of their best quarters ever. They had a similar quarter like that in 2021 Q3. It'd be slightly ahead of that one. And then Q3 of 2022 was also the best one ever, but that was when they officially acquired Metro Mile and gained a lot of customers just from that acquisition. So that gives us some idea of where the customer count could come in. Now, in terms of their in-force premium, well, the guidance for this quarter is that in-force premium might be like $879 at the high end, $879 million. Now, Lemonade has a history of beating guidance. It's a great tweet here by Henry Invests in June of this year, 2024, about how often Lemonade beats their guidance. They tend to almost always beat their guidance. And you can see in-force premium guide and in-force premium actual. Since he's looking back here, Q1 2022, they've always beaten guidance, and it's varied overall in the whole book of business. It's usually often by a couple percentage points. Back to this tab, 880, I'm going to guess it's like 880 million plus in terms of in-force premium. My number, I think is too high. Honestly, feels too high, but what I'm getting right now is about 912 million in-force premium for this quarter. Here's how I'm going to get that, right? I take the previous quarter, 839 million, so what the book of business you had. Then I'm adding 25 million. Now this 25 million is from rate increases. So here was, I think it's right here, a tweet by Tim Bixby, Lemonade CFO. This was back the end of last year. I asked them for some clarification of what this paragraph meant in their letter. And basically, Tim said, hey, we expect about 100 million plus from increased rates to come online during 2024. So when I've been sort of modeling this out, I'm assuming, hey, as people, they renew policies with someone that has a renter's policy, pet policy, home, car, whatever it is, they increase the rate kicks in with that person, and it right away increases their in-force premium a certain amount. So I'm estimating based on this number, it's about 25 million a quarter across this year. And then I have minus 12.5 million. If I flip back to this nice little summary sheet here, it says they expect to do non-renewals of about 20 to 25 million of IFP in the second half of 2024. So basically said, hey, there's there's home customers, especially likely home customers. They think these are not profitable customers. We can't get the rates up adequate to where we want them to be, so we have to non-renew, cancel these policies because the math, it just doesn't make sense. So I'm assuming 12.5 million, the worst end of that, is being subtracted out. So 12.5 million, and then I'm adding in the number of customers that they overall gained, which is about 2.4 million or 243,000 customers. So that's more than this sort of net customer change of 160,000. That's because a lot of customers that they gained also, there'd be a portion of the whole book of customers that churned away. So you have a net change here, but I'm in my equation here, I'm using this customers acquired of about 240,000 customers. That just boils down to how much you're spending per customer and how much overall gross spend, because they're spending $37 million a lot, and I'm saying only $155 per customer, even though they're spending so much. Well, you get that 240,000 customers coming in. And that I'm then multiplying those customers by what I'm calling a new customer premium per customer. So I'm trying to estimate down here in this little block of lines, what is the average new customer premium per customer? I'm saying $275 per customer in Q3. Actually seems kind of low. Given the mix of the product mix, I feel like that's a little bit low. How am I figuring that out? I have this line here that says percentage of sales that were upsells or cross sells. And I have 30% here. If I go back a few quarters, I have one blank quarter I'm ignoring because that was the Metro Mile acquisition quarter. But going back to Q2 of 2022, I have 21%. And I'm bringing up a say question here. It says, this was a question, at least I really liked the question because it gave it we really got into some of these specific modeling details. And Daniel gave me a really great answer. This was the end of Q4 results of last year. And I said, hey, in Q2 2021, 21% of non-car sales were cross-sells or upsells. In Illinois, because that was one of the first states they rolled out car, it reached 36%. So 36% of what they were selling for premium was just coming kind of in the door for free from a cross-sell or upsell. So now I'm saying, what's the current cross-sell upsell rate with car and without? Daniel gave this really, really great answer. He said, hey, over 2023, about 25% of non-car sales were cross-sells. So in all our other products combined, at about a quarter of the sales came from existing customers. If I include car, then we get closer to 30% on a nationwide basis, even though car is not available in many of the states. So on a nationwide basis, about 30% of sales are coming in the door for free as existing, renter customers buy a car product or whatever it is. But 36% in Illinois, that's kind of our little, petri dish sample, with car really available was more like 36%. And it started at 21% back in Q2 2022. Then back in my model, I'm taking what that percentage is and looking at, hey, all the premium they gain, including premium that, accounting for what's churned away, how much they're gaining. And then I'm saying, hey, doing some math there to say what the new customers they're gaining, what premium per customer would they need in order to balance out that equation of amount of premium they gain. So, and this is a bit of a guess even at Q2 because the amount of premium they're cross-selling gaining with car included on a nationwide basis. Maybe it was 36% in Illinois with car, 21%, nationwide without car. Maybe it's something in between. So maybe it's 25%, maybe it's 23%. It's not a huge deal because we're trying to get some historical numbers so we can sort of more accurately project into the future. And then I've kind of just assumed that steadily rose up to, he said, in 2023, they were close, around Q4 at that time, they're 30%. And then this year, I'm keeping it at about, assuming 30% of their sales are that. And then you get sort of, an equation of what the new, or results for what the new premium per customer might be. You can see, a few years ago, it might have been in the $200 per customer, and now it's scaling up to maybe it's more typically been $300. It depends on the quarter too, because Q3, again, they probably get more renters and that kind of thing joining the company. So it gives you some idea there. It's also really, really tough to sort of accurately predict what this could be because inside of the premium you're also gaining premium just from rate increases. You're also losing premium from non-renewals right now. So there's some challenging dynamics here from a modeling perspective to try and get accurately, but doing the best we can. I think like this value of Q3 of 268 is probably pretty accurate because I don't think there was as much non-renewals happening then and probably not as much rate increases bouncing in either. So something in that range. And then I'm saying, for Q3 of this year, a slight increase on that $275 per customer. Yeah, it's again, tough to predict that, but that's roughly what I'm going with. So you go back to the first premium calculation here, and I have those new customers gained multiplied by that average premium per customer. And I'm also saying down here, hey, look, if based on these cross-selling values that Daniel gave us, we can calculate percentage of overall book of business, that's sort of percent change that's occurring just from cross-selling, upselling. So it's been, in the 2% something range. So I'm taking the average of the last 4 quarters, multiplying that amount of premium by that. And then I'm also multiplying all that by annual dollar retention, to the power of 1/4, or sort of a 1/4 of that sort of 12-month basis churn of premiums would be. Put all those values in and you get that IFP of somewhere around 912. Also doing some of that exact same kind of math again with another 25, 12, same kind of averages there. I might even drop the new customer premium per customer for this. I mean, it's hard to say because they should be starting to ramp CAGR up. So I have $334 per customer then versus $320 of Q4 last year of new customers coming in, and that gets you to 968 million IFP for the whole year. So I don't know if we'll beat it as much in Q3, but that's not crazy to beat 944 at the high end for the full year, and I'm at 960 something. Not a huge crazy beat. And of course there's a lot we don't know. How maybe all 25 million of non-renewals come out in Q3 and that makes Q3 look worse. Maybe they shift back and forth. There's a lot of factors that can influence this. Again, I hope these videos, if anything, just helps you illustrate the underlying mechanics of the company and how the unit economics are improving, and not so much, hey, paper bags trying to make a perfect prediction. And that goes when my predictions are accurate or when my predictions are wrong. That's always helpful for myself to remember, everyone else to remember too. So that gets you, though, where your customers could end up, where your premium could end up. My customer acquisition cost in Q4 I have right now at 190. I have that graphed out here as well. So this was in CAC versus growth spend. This includes this hypothetical, upcoming quarter, Q3 2024, with this data point right there where they spent a ton and they had so much customer acquisition cost. And then I highlighted some of the Q4s, where Q4 tends to be more expensive just because I think, well, it must be less transition for people, so people are moving less likely to need a product. And also there's Christmas in their holiday season where there's more competition for advertising dollars, more competition for people's attention. So you have to expend a little more to get the same result. So based on that, and based on also there was in one of the earnings reports, they had this note that says they plan to roughly double their growth spend in 2024 from 55 million in 2023. So they're going to spend about 110 million in 2024. So if I flip back to the model here, so you can look at that growth spend line. You can sum those 4 quarters up and have 110 million, and the balance in Q4 is 110 million minus the sum of the rest, which is probably 27 million spent in that quarter. And then if you look, 26, 27 million range here, you're trying to look where these green dots might line up. And I'm guessing, this one here was 27.9 million. It was 191 dollars per customer. So we'll have to see how it comes in, but that's sort of where I plunked the numbers in at $190 per customer in Q4. So the next big thing to talk about is the gross loss ratio for Q3, Q4. Obviously the effect of catastrophic events and how much they're affecting the loss ratio and how much Lemonade is exposed to them can make a really big difference to your overall loss ratio. But there was 2 named storms that hit the sort of southeast coast of the U.S. And the biggest product for catastrophic losses is going to be your home insurance. Luckily for Lemonade, if you look at Florida, look there first, type that in. Florida, they don't offer home insurance in Florida. So they're not going to have a lot of exposure there. They do offer renter's insurance. I mean, you could have maybe something floods and your TV gets wrecked or something, or your laptop, and I would think you could be able to make a claim then. But the losses, again, on a renter's insurance policy are going to be much smaller than someone whose home was destroyed by a hurricane and needs an entire new house built. So it's great. They don't have exposure there of homeowners insurance in Florida. If you look at other states, Georgia, they do have some exposure. And if I pull up from last quarter, Q2, all their gross written premium for Lemonade, Georgia is about 6.8%. So there's an amount there, but it's not a crazy amount. 6.8%, 3% of everything they're writing is Georgia. And that would include not just homeowners insurance, but all other products where Georgia is available. They have pet insurance, life insurance, renter's insurance. And then other ones maybe to look at are North Carolina, South Carolina. Homeowners insurance they have in North Carolina, not South Carolina. And that's, but then otherwise you're talking about pet insurance, other products that are much less relevant to the cat effect conversation. And North Carolina doesn't even show up on the list to be part of that all other category, which is 24%. So Lemonade should have pretty limited exposure to those two hurricanes that occurred. We'll see though, it's again tough to predict even in Georgia how much damage that occurred and how that affects the overall loss ratio. We can kind of look forward though into the quarter. So in my model here, again, if you like what I'm doing here at the channel, you interested in Lemonade and want to go deeper, you can join my Patreon. You get full access to this Lemonade model. So I encourage you to do that if you want to support me in that way. That's awesome. But we have down here, lower down in my model, I have a few other numbers tracked by a few other insurance companies. One is Progressive. I have company-wide net catastrophic loss ratio, and then property net catastrophic loss ratio. So how much of their loss ratio is due to catastrophic events. And for Q3, Progressive had 7.8% of their property. And you can see the fluctuations here, how dramatic they can be. For Progressive in Q2 was 75%. That's not a typo. Versus 7.8%. Even if you look at the 3-month results for Progressive, you can see the middle month of the quarter is 173%. So massive fluctuations here in this end result number. And then Travelers Insurance they released their Q3 loss ratio catastrophic effect on their loss ratio for their home insurance product, and plotted those out for those Progressive property and Travelers home. You can see this is again their catastrophic effect on the loss ratio, and versus where Lemonade's come in, you can see it's really not a huge, really bad quarter Q3 for Travelers or Progressive relative to where some others have been. So if if it lined up Lemonade in a similar way, there you can see that there's some correlation here is I guess the point I'm trying to make. And overall, over time, Lemonade should be increasing the amount or improving their exposure to cat risks. So if we go back to Q1 of this year, you can see sort of a similar amount for Progressive, Travelers, and we had a 47% home catastrophic loss ratio. And so something like that, right? So what I plugged in, kind of did the math here for Lemonade was, hey, Lemonade's home catastrophic loss ratio is 50%, for example. And let's say home product is about 17% of the book of business. Is also an estimation, but I think a pretty good estimation. And then I'm saying, hey, home is responsible for 85% of the catastrophic losses. So there's some other losses from renters, from some auto, that kind of thing that might be included on it. Typically, that gets you to an overall book of business for their overall catastrophic loss ratio is 10%. and their ex-cat loss ratio, I'm putting at 60%, a 2% improvement over the previous quarter as they continue to underwrite better policies, have better pricing improve. So 60% there. You add 60 plus 10 gets you to 70% loss ratio. We'll see if I'm at all right or where I'm wrong in that. But that's what I've gone with for the loss ratio. Also, if you look at Domien on Twitter, he's a great follow, and he has a video. I'll link it down below in the description where he talked about the sort of makeup of different percentage of the book for different products for Lemonade and where each loss ratio might be. I did this independently without looking at it, and then I saw, at least right now, he has about a 70% overall loss ratio for Q3 plugged in there. And his home catastrophic loss ratio is also showing 50%. So actually lines up basically nearly exactly with what I have. We'll see if either of us, if we are correct or not. And then in Q4, I'm just plugging in 70% as the overall result for their loss ratio. Their overall expenses, I have kind of staying fairly steady, everything other than their growth spend, just having small increases in those, but we should expect a lot of operating leverage, and that gets you to, total expenses or expenses relative to your gross earned premium, 54%. Last quarter, 56, and then 48% in Q4. 56, it's going to be higher. Q3, just because they're spending so much on growth spend. And then as that growth spend decreases some, you have less, and then if you're looking out next year, maybe that number will keep dropping, right? But you get to adjusted EBITDA of minus 43 Q3, and then minus 30, minus 29 for Q4. For the whole year, if I sum those 4 quarters up, you have about a minus 149, minus 150. So that coincides well with their guidance there, minus 155, and we're to minus 151. So right in that range. Wouldn't even be surprised if some of those numbers I'm showing do slightly better and they have a little bit better beat on the adjusted EBITDA. But very exciting time for Lemonade, as you think about as they cross-sell more heavily into car product in the next couple years, as home product becomes less of a burden and more, maybe even a slightly profitable product that they can sell as rates become more and more adequate. I expect that we will see an increase in growth, so IFP year over year, might get back into the 30% range. If that does, you think, maybe by the end of 2026, they're at 1.7 billion of in-force premium from, maybe just under, 900 and some million this end of this year. So pretty significant growth that could come over the next couple of years. On top of that, if we continue to see operating leverage, the unit economics get better and better, where your cross-sell premium as a percentage of IFP starts to grow. See, maybe they're getting 30% of their sales right now is from cross-sells, but then as car goes online everywhere, maybe it matches what Illinois was doing back, back in Q2 of 2022 when they released that note about it doing 36% with cars. So that's kind of what I have modeled out. Hey, they're going to start doing 36%. Their new customer premium per customer rises because they are start to sell not just to renters, pet insurance customers, but also maybe to more car insurance customers right out of the gate, as well as cross-selling to those customers. So all those sort of metrics improve your overall efficiency, your overall marketing efficiency. And then if you're growing, if they can pick up their growth more into the mid 30% range for the next couple of years, and if their loss ratios can stay in check, maybe around the 70% gross loss ratio range, it's like, well, then somewhere in 2026, you're probably going to reach adjusted EBITDA profitability, which I had tweeted this out earlier today. Basically said, I'm basically all in on 2 stocks, Tesla and Lemonade. Next 2 years should be very interesting as Tesla rolls out robo-taxis and Lemonade reaches profitability. Exciting times. And Dave Lee, love Dave Lee. He said, when do you think will be Lemonade's first profitable quarter? And I said, hard to say the quarter, but 2026, as they continue to have operating leverage and as the cross-sell car to existing customers, I think they're going to get there. And that's sort of, what my model is showing. But that's also what management is saying. Lemonade management has a history of giving targets and then successfully meeting those targets. So they're saying cash flow positive 2025, adjusted EBITDA positive during 2026. And then on top of that, this was from May of this year, where Daniel Schreiber said, he pointed out, over the last 2 years, gross profits of 3x, in-force premium as 2x, operating expenses are roughly unchanged. And I think we'll continue to see that operating leverage for Lemonade as they grow. And then he said this multiple times. He said it in my last interview with Daniel, but he's also said this, a reply to one of my say questions. He said CAGR is going to lose share in 2023, carrying its own weight, maintaining share in 2024, and then growing afterwards. It won't really hit its stride until 2025 when they'll start to grow more aggressively. So again, that's where I think you flip back to the model, all the unit economics improve as they're able to cross-sell these more expensive product lines to existing customers. And then finally, just to look at my say questions for Q3, let's have a peek at those to finish off the video. One thing, the question I think will be asked, because it's already have 35 votes and 44,000 shares, it says, do you view increasing collaboration between legacy insurers and Palantir as a potential challenge or risk to Lemonade's business model? This has been, I've seen people on X discussing this in the Lemonade community. I think it's a very fair question, and certainly a realistic potential risk. I gave an answer, a reply to someone here on X back on October 12th, basically saying, my opinion right now is legacy companies with large amounts of people and many internal conflicting interests, meaning, even if they become more efficient, that means more of the organization should be fired. But it's tough for an organization like that to actually change, because parts of the organization don't want change to occur, so they resist change. That's why you get a big sort of bloated legacy company. It's difficult to have that culture shift because there's literally people that don't want anything to change, so they drag their feet. This will never achieve the same efficiency and depth of value add as something that is built from the ground up and is highly lean and nimble. Tacking on impressive software may bring gains, but will have its limits. Less shareholders and managements have the guts to make ruthless cuts and changes. Think Elon when he bought Twitter or X. Then true transformation will not occur. And nearly all shareholders and managers of large legacy insurers do not have these guts. That's my opinion on that first question, but I still want to ask it, hopefully get Lemonade's overall perspective on it. And then the next question is, how can your home product be differentiated from legacy insurers, given that home insurance often requires a personal touch, empathy, maybe more personal empathy, on-site inspections, back and forth with a customer? How do you address these needs in a more efficient way? And that's a tough question. I don't know if the home really ever will be as differentiated as, say, car insurance, where Lemonade has this customer base that is young and tech savvy and is okay with having their phone location tracking and how fast they drive and how quickly they turn and where they go, what times of day. If it improves their insurance rates, that could really differentiate a car product. Home, I don't know as much how they would. So it'd be interesting, though, given some of the problems with home, how it's not a very profitable product line. Interesting to hear that. And then are you done with non-renewals? There will always be some, but are you at least done with the extraordinary amount of this inflation cycle? Just to get some clarity on that would be helpful. So again, thank you so much for watching. I hope you found this valuable. If you want full access to this model, you can join my Patreon. And remember, it's in the bag.